Well. Do we have a clown stock to analyze today? Welcome, ladies and gentlemen. Welcome back to Strongman Personal Finance. We got to talk about LYFT. Lifter, my sifter. Now, LYFT is a ride-hailing company. You want to go somewhere, you don't want to take a cab, some stupid yellow cab. You download this app on your phone, and you click a couple buttons. You let some freak get your location, and then they come pick you up and take you where you want to go. And then after that, you go on your merry way. Now, there's two main ride-hailing apps out there. There's Uber by Goober, and there's Lyft by Sift, by Shark Shift. I don't know. But me personally, I use Lyft. Why? Because I'm a very cheap man. But does that mean I would invest in Lyft? See, a lot of clowns out there, especially Tesla shills, they have a Tesla car, right? Like, I'm upper middle class and I live in California. I'm a douchebag. I have a Tesla car. Look at me. They invest in stocks because they like the product. Okay. I love Lyft. I love Uber. It's amazing. But I would never buy these clown stocks. Okay. Let's go ahead and check out how Lyft stock has done recently, because all that matters is whether the stock went up or down. So Lyft is down 84% ever since, I guess, it started trading in March 29th, 2019. So even before the clown market, this stock started trading. Whoa, what just happened there? It's almost like they started to delete Lyft. So Lyft is down 84% since it IPO'd, it looks like. And in the past week, we've had an absolute collapse. It's down 32%. Why does my computer keep freaking doing that? It's annoying. And it's down 30% in the after hours. Now, a lot of guys are like, a lot of gals too, we welcome everybody to Strongman, okay? A lot of people are like, well, it went down, so it can't go down anymore, right? Well, if you have any kind of like training in financial statements, you can clearly see a company that loses money every single freaking quarter actually has a value of zero. I know. Would you want to buy a company that just loses money? Hey, we're going to have lots of revenue, but every year we're going to lose more and more money. Isn't that a great investment, guys? Yeah. Now I want you to take the present value of the future cash flows of a bunch of negative freaking numbers, and you tell me what your intrinsic value is. Shut up. Let's go look at the earnings, okay? Now, they have the condensed consolidated balance sheet, okay? This hurts my eyes. We'll go look at stock analysis in a second. But they have the quarterly balance sheet, and they have the quarterly consolidated income statements, okay? Now, on the top line, we see something very interesting here, okay? This is revenue. Revenue's going up pretty consistently, right? In the first quarter of 2021, it was $609 million, and now revenue in the fourth quarter is $1.1 billion. That's a lot of freaking revenue, okay? But then you see something right here, and we'll look at bigger financials. I know it's hard to freaking see. Loss from operations, $596 million. So they had revenue of $1.1 billion, but they had a loss. You understand? Do you clowns understand the word loss? I guess that attracts you clowns to buy stocks like this. They lose his money. I'm going to buy it. I'm stupid. Excuse me. So they had a loss of $596 million from operations and a net loss of $588 million. Now, I wonder, it seems like a lot of that came from cost of revenue. That's very, very interesting, okay? Let's figure out their gross margin. So we take 1175 minus the cost of revenue. I don't know, are they like paying their drivers more? I don't know. Divided by 1175. So their gross profit is 34% this quarter. And then last quarter, let's go look at what it was historically, okay? Gross profit, 45, 34, 49, 40, 54, 54. Okay, so their gross profit's kind of all over the place. But in general, it's kind of like in the 40s, maybe 50s, with some, dips down in the 30s. So it's not unusual that their gross margin is 34%, but it was particularly worse than it normally is. But you can see, let's zoom in here, okay? If a number has brackets around it, that means it's a loss, okay? Let's go from left to right. We're going to start here. Brackets, 416. Brackets, 240. This is so hard. This is like accounting is like magic, okay? 205, negative. Brackets, 273. Brackets, 199. Brackets, 373. Brackets, 290. Brackets, 396. Oh, wow. What an amazing freaking company, okay? Now, here's the statement of cash flows. Let's see how much cash they burned from operations. So in Q4, they burned $33 million of cash. And if we look, the quarter before that, they burned $26 million of cash from their operations. Burned it, incinerated, gone. 25 million, 152 million. What was that because of? Prepaid expense. Okay, I guess they prepaid a lot of stuff. but every single freaking quarter, except for one, they have negative operating cash flow. And a lot of that was from accrued liabilities. Okay, this one quarter where they had positive cash flow, it looks like because they incurred a lot of expenses that they then obviously had to pay out the next quarter. But overall, their cash from operations, they're burning it, okay? You look at their net cash provided or used in investing activities. Cash flows from investing activities. Positive, 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 negative, negative, positive, positive, positive. Okay, so it looks like they're selling their investments, marketable securities to sustain their operations. They're basically living off their the cash, the current assets on their balance sheet to survive. Because we can look here, and this is their cash flows from financing activities, okay? They're repaying loans. They repaid some loans. They had some stock options. Oh, I wonder what the stock-based compensation expense is. We'll go look at the full year's financials in a second. Taxes paid related to net share settlement of equity awards. Okay, I guess they paid some, I don't know, payroll taxes or something. Principal payments on finance lease obligations. But you see there's not a lot of share issuance. So the company isn't making money from operations, and they're spending money on financing. So they're living off of their investing activities, which principally means they're selling their investments to sustain their negative cash flows from operations and financing. Long story short, they're delaying the inevitable. And what is the inevitable, ladies and gentlemen? Either a massive debt issuance or dilution. They're going to issue shares because they can't make freaking money to save their lives. Okay. I don't need these earnings to tell me this is a clown stock. Okay. Let's go look at their press release. Oh my God, we're so amazing and perfect. Look at our EBITDA, our fake earnings. For Q1 2023, we anticipate revenue of approximately $975 million. How does that compare to the prior quarter? Let's see. Q1. Okay, it's up. Their revenue's up from that prior quarter. That's good. We have not provided the forward-looking GAAP equivalent to our adjusted EBITDA outlook or of a GAAP reconciliation as a result of the uncertainty regarding and the potential variability reconciling items such as stock-based compensation and income tax. Okay. So Uber or Lyft posted a massive freaking loss, okay? And they're not giving us their forward-looking GAAP equivalent to adjusted EBITDA. I don't even know what that means. I'm an accountant. I don't even know what does that mean? They're not even giving us their future projections besides, okay, their revenue for the next quarter and their adjusted EBITDA. Now, let's go look at their actual financial statements, okay? I'm curious what their stock-based compensation is, but we'll go ahead and look at their balance sheet first, okay? So we have a comparative balance sheet. And oh, by the way, before I go on, if you want to meet me one-on-one for some accounting tutoring, there's actually a link below. You click it, okay? It's in my description of my videos, and you can book a one-on-one with me, and I can actually teach you accounting, okay? But I guess you can just pay Jeremy too, whatever. Anyway, total current assets. So total current assets have gone down from 2.7 billion to 2.5 billion. What's the changes? Cash went down, short-term investments went down, and prepaid expenses went up. Okay, pretty typical, but their current assets went down. Let's look at their long-term assets. Restricted cash and cash equivalents, whatever they're restricting it for, went up. Restricted investments went down a little bit. Let's see if there's any major changes. Other investments went down. Property, plant, and equipment went up. Operating lease right of use assets went down pretty significantly. I don't know if that's from amortization or they basically are coming at the end of their leases, or if they, I don't know, ended a bunch of leases and didn't renew them. Intangible assets went up. Goodwill went up. They had some kind of acquisition. Goodwill went up by $80 million. Interesting. Okay. So overall, their assets, their net assets went down by approximately 200 million, and their total liabilities went up pretty freaking massively. Okay. It looks like almost $700 million. So assets down, liabilities up. What does that mean? That means their equity probably went down. Okay. Assets equals liabilities plus equity. I know it's hard. Let's look at their debts. All right. Insurance reserves. Wow, that's interesting. So insurance reserves are up 40%. I'm curious what that is. Accrued and other current liabilities are up. Okay. Total current liabilities are up, mostly because of these freaking insurance reserves and accrued liabilities. Let's look at their long-term debt. Okay. Long-term debt's up by $150 million. Oh boy. So you look at the equity section, right? This is not pretty. Let's zoom in on why the equity changed. Well, we see stock, common stock, and additional paid-in capital has gone up. That increased. What does that mean? That means they issued shares. A lot of shares went out there, okay? What does that mean as the investor? Dilution solution. Other comprehensive loss. Oh, that also went down. That could be foreign currency, could be pensions. I don't think it's pensions, but there's only a couple things that go into that. And then there's accumulated deficit. Went from 8.3 to almost 10 billion. So it looks to me like they got $1.6 billion roughly of losses in the span of a year. 1.6 billion of losses. What a clown show. Let's see. What a freaking joke. Okay. So basically they're issuing shares. Look at this change in shares. Class A shares authorized. Let's see. Class A shares issued and outstanding respectively. So their shares, it looks like, went up from 336 million shares to 361 million shares. So what was their Class A share dilution? 361 divided by 336. 7% dilution in the span of a year. Okay. Let's see. Class B shares. So Class B shares stayed exactly the same. Well, I guess that's a good thing because I don't know. Oh, look at that. Their total loss for the year was almost 1.6 billion. How did I know that? What a freaking disaster. Okay. This company is a joke. All they do is lose money. They just dilute you and lose money. And you freaking clowns keep buying the stock. Why? Because you're clowns, okay? Oh, let's go look at stock-based compensation. Okay. Oh, my God. Oh, these tech companies are such a joke. So we go to the statement of cash flows, right? And we see this line item, stock-based compensation, add back. Why? It's a non-cash expense. But what would what's his face say? Joseph Carlson. This should be under investing activities. Yeah, okay. Stock-based compensation, $750 million. Oh, baby. So their stock-based compensation expense. Let's do 750 divided by 750 divided by 4095. Their stock-based compensation was 18%. 18% of their expenses are stock-based compensation. What a freaking joke, okay? This company's a joke. Look at this cash burn. All they do is just burn more cash. Look at the year-over-year change of cash. They burned $237 million in freaking cash from operations, okay? And of course, they lived off their balance sheet because they sold a bunch of their marketable securities, so they wouldn't have to freaking dilute you. But guess what? At some point, they're gonna dilute you, okay? This is a clown stock. Lyft is a clown stock, okay? I guess maybe if we have time, we'll do Uber later. But this is a freaking joke. What a disaster. Let's see. Daddy's here. You're going to miss out on the gains. See, here's the thing. So this stock's down like 33%, right? You know what these clowns are going to do? It's going to go up like 20% tomorrow. And they're going to be like, see, you should have bought the dip. Strongman doesn't understand investing. Like, okay, buy Lyft, whatever. I hate Lyft with a burning passion. I work for them, and they do not give one F about the drivers. Yeah. Lyft my sniff. I knew this would eventually bite them in the butt. I'm so happy to see their disgusting earnings get decimated. Yeah, they're not doing too good. They don't make money. What do you think about CVS buying Oak Street Health for $10 billion besides the negative cash flow? I didn't even know that happened, to be honest. I did a lot of taxes today. My girlfriend wants to leave me for strongman. I get that a lot, guys. Okay. Don't worry. Your girlfriends are safe with me. They can just spend the night. I promise. I'll just put them on the couch, feed them a nice dinner, and then that's it. That's all that's going to happen. We should get into the Viagra business. Imagine a pill called LYFT. I like that. Why are you talking about this clown stock? Because the clown stocks are easy. Of course. You just look at, they have a bunch of negative numbers. And you're like, see, the numbers are negative. See the negative numbers, guys? Well, I understand. Let's see. Please check on Ape Father. He's fine. Yo, strongman, it would be an auspicious decision to purchase Chrysler GD stock. I heard they were making these M1 Abrams. News is Saddam is invading Kuwait, and we need... What? I didn't hear about this. Assets are less than liabilities. Paul will buy the stunk. Of course he will. Let's see. Let's go back and look. They do have stockholders' equity. Okay, yeah. I didn't even think to check that. So they do still have stockholders' equity, right? But they could very quickly be underwater, which means they're going to have more liabilities than assets. It could happen very, very soon. I mean, it could happen next quarter. Oh, God. Look at this. Look at this. Look how low this look how low their equity is. Okay. Their assets minus liabilities. So their equity is 388. If they have one bad quarter, because look at their normal quarter, okay? Let's see. Okay, sound like a little foo-foo. Okay. Look at their net income. Negative 422, negative 377, negative 190. Yeah, then by next quarter, they're going to be underwater. They're going to have more liabilities than equity if the trend continues. Unless they issue more shares, of course. But we'll see what happens. I don't know. Not my problem. Hello, shirtless man. Lyft and Uber is a good trade. Buy after everyone sells and sell when the dummies buy. Yeah, maybe it's a good trade, but it definitely ain't a good investment. Your pecs are looking extra hairy today. Thank you very much, sir. All right, I may cover Uber stock, or maybe I'll cover PayPal, my snace now. I don't know. What are your top 10 stocks to buy for the Chinese invasion of the Philippines? Let's see. Every military-related stock, whatever. Lockheed Grumman. No, I'm just kidding. Lockheed Grumman. Anything military-related. Trading stocks, even as profitable to middle-class person in my country, they're heavily taxed. Better to go VT. They're pretty heavily taxed in the United States, too. Paul listened to me, and now in his videos admits that his stock analyzer doesn't take in the value of the balance sheet. He says it now before using it. He doesn't know. He's a clown. He doesn't know anything, okay? Oh, number into stunk analyzer tool. I made the tool in 30 minutes. This is not rocket science, okay? All right, that's it. Maybe I'll do another video. Maybe I won't. We'll see how I feel. It's 8:37, and it's freaking hot in here. All right, talk to you later. Cheers.